We're back in that season every trader loves to hate, earnings season. Now, just look at Tesla and Nvidia overnight and your account can scream 20% higher or get completely wiped out by a single line in a financial report. If you want to understand how the options market actually prices that risk so you can protect your capital, you need to watch this video. I'm Grant, and in 2022, I blew up a $650,000 account because of stupid, avoidable mistakes. I survived, but I had to tear down and rebuild my entire trading system from scratch. This channel exists so you don't have to pay the same idiot tuition that I did. Now, if you want a zero fluff approach to the markets, hit subscribe and join my community in the bio. Now, back to earnings. If you think this season is as simple as good news means buy calls and bad news means buy puts, you are just flipping a coin. I've been there and I've bought calls on a massive earnings beat only to wake up the next morning seeing the stock down 12%. I sat there watching my account evaporate, having no clue what just happened until I realized a bitter truth. The market doesn't trade results, it trades expectations. Before every earnings call, the options market has already priced in exactly how much a stock is expected to move. For Tesla, the pre-earnings expected move was around plus 5 to 6%, with the market betting the stock would land in a tight range despite the hype. For Nvidia, it's typically plus 6 to 8% based on historical and current IV creeping up. We call this the expected move. If Tesla was sitting around $430 pre-earnings, the market was saying post-report it'd be between roughly $405 and $455. If you're out here buying $435 calls or $425 puts, you are literally standing in the middle of a minefield. But here is where I lost my stupid money. Right before the report, everyone is FOMOing in and everyone is buying options, and that pumps up premiums like a massive balloon. This is implied volatility, or IV, and the second that report drops, the uncertainty vanishes and that balloon pops. We call that the IV crush. When IV collapses, the value of those options contracts bleeds out instantly, even if the stock doesn't move an inch. I've been right on direction before and still took a massive loss because the IV collapse was too fast. That's when it clicked for me. Earnings is a paradise for option sellers and a graveyard for people who only know how to buy naked calls and puts. I don't care about the beat or the miss anymore. I only care about how much risk the market is pricing in, and if I'm being dumb enough to buy a balloon that's about to burst. Let's look at a real example. Nvidia usually reports towards the end of February. Right now, as IV starts to creep up but hasn't been blown out of proportion yet, this is exactly when I start setting up my positions. I'm looking at calendar spreads or bull put spreads. I never wait until the day of the report to take action because by then the premiums are overpriced and the risk to reward ratio is pure garbage. A professional trader plans early to capture the best pricing. You want to be the one collecting the premium, not the one overpaying for it. At the end of the day, trading is a game of probability and nobody can predict the future with 100% certainty. After losing that 650k, my process is now strictly 3 steps. 1, check the expected move to find the kill zone. 2, check the IV rank to see if the options are cheap or expensive. And 3, never, under any circumstance, go all in on a single earnings play. Trading isn't about being right, it's about surviving long enough to keep playing. Earnings season is a goldmine if you have discipline, but it's a grave if you act like a gambler. I don't care if you're bullish or bearish, I only care if you're still alive when the dust settles. Drop your plan in the comments below and don't forget to subscribe so you don't miss the next deep dive. I'm Grant and I'll see you in the next one.